Markets cheered the significant progress in the U.S.-China trade talks, boosting stocks in the U.S. dollar and easing recession fears. But how might the FX market move on this week's events? It's the week ahead at XM.com. Thanks for joining us. I'm Cristina Marujos, and with me today is Haralambos Pissouros, our senior market analyst. Haralambos, starting with the United States, Fed rate cut expectations are back in the spotlight after the latest U.S.-China trade developments. We'll have a plethora of Fed speakers this upcoming week, as well as the latest PMIs. So how might the dollar move?
Hello, Christina. Yes, risk sentiment improved significantly following the US-China trade deal. A better-than-expected outcome eased significantly recession fears, with investors scaling back their Fed rate cut bets. From penciling in more than 100 basis points worth of reductions this year just after Trump's Liberation Day, they are now expecting only 57 basis points, which brings us closer to the Fed's latest dot plot that pointed to 50 basis points worth of rate cuts by December. Now, next week, traders will monitor the preliminary PMIs for May, but they may also pay attention to speeches by several Fed members, as they may want to hear whether the committee remains concerned about economic growth or whether they are more focused on the inflation outlook following the latest trade deal with China. Now, rising PMIs may suggest that sentiment among businesses has improved after the trade accord, but investors may also want to hear clear remarks about how the Fed is planning to move forward. If the Fed officials appear concerned about the upside risks to inflation, the dollar could extend its gains as traders could price in even fewer rate cuts for 2025.
Inflation is going to be a theme of the upcoming week, but before we turn to that, let's look at the central bank front. The Reserve Bank of Australia is expected to deliver a rate cut this upcoming week. How could it affect the Aussie?
A rate cut on its own is unlikely to be a strong driving force for the Aussie because it's already fully priced in. And that's why I believe that traders may direct their attention to clues and hints about how policymakers are planning to move forward. The uncertainty surrounding the global economic landscape due to Trump's trade policies has led investors to price in around 80 basis points worth of reductions by the end of this year. However, with underlying inflation metrics near the upper bound of the bank's 2 to 3% target range, and also taking into account the US-China trade deal, I believe that policymakers are unlikely to corroborate the ultra-dovish market consensus. I believe that we will get a less dovish than expected message, which could allow the Aussie to gain some more ground.
Now let's look at the pound. We'll get the latest CPI and retail sales reports from the United Kingdom. Could the data support sterling this week?
Yes, we get the UK CPI data on Wednesday. We also get the preliminary PMIs for May on Thursday, and as you said, the retail sales on Friday. Now, after the latest Bank of England decision, Governor Bailey said that they need to stick to a gradual and careful approach when it comes to interest rates, which allowed investors to reduce the amount of rate cuts expected by the Bank of England this year to around 45 basis points. So, should the data point to sticky inflation, improving PMIs, and robust retail sales, I believe that investors may become more convinced that only a single extra quarter point rate cut remains in the bank's chamber for the remainder of the year, which, in my opinion, could push the pound higher, a currency that, due to the UK's twin trade deficit, sometimes acting as a risk-sensitive currency.
I see. It's without a doubt a busy data week. And before I let you go, Haralambos, the calendar also holds Eurozone PMIs and inflation stats from Canada and Japan. So how might these data sets affect their respective currencies this week?
Now, the ECB cut interest rates last time, and it is expected to do so again in June. However, the improving trade environment and remarks by ECB member Isabel Schnabel that interest rates should remain close to current levels have led investors to pencil in only one more reduction after June. In other words, the market expects one in June and another one by December. So a round of improving PMIs could corroborate Schnabel's view and could add extra support to the common currency, the euro. Now in Canada, the latest weak jobs data, we got weak jobs data for the last couple of months, and that increased the probability for a June Bank of Canada rate cut and took that probability to 65%. In my opinion, if inflation slows further in Canada, this could solidify the case for a June rate cut and could weigh somewhat in the Loonie, which strangely has been performing very well amidst this trade, even when we had the uncertainty surrounding tariffs and trade. Now, with regards to Japan and the Bank of Japan, the acceleration in the Tokyo CPIs for April suggests that the national prints could move in a similar way, thereby adding more credence to the case of another rate hike by the Bank of Japan before the end of the year.
At Ellenbos, thanks so much. This was The Week Ahead at XM.com.